Silver is, as far as I know, the most volatile, highly valuable commodity on the planet. The ratios, at least when I monitored for gold, were much less extreme because gold, although volatile, is nowhere near as volatile as silver. And the time premiums and the volatility premiums in futures markets for other materials seems to be nowhere near as extreme as it is in the silver market. There was also, I think for 40 years probably, an institutional bias that the silver price was declining, while there was a popular bias that the silver price was increasing. So you had a natural war between buyers and sellers on the COMEX. I think that the institutional bias is much less likely to be short now than it used to be, and perhaps as a consequence of that, the volatility will die down. But in direct answer to the question, I don't know of any other commodity in the planet that had the mismatch between the claims volume, which is to say the futures volume, and the amount available for good delivery.
So, Rick, it begs the question, can we have an honest silver market? Is the silver market then always subject to manipulation if it's not a true market structure? And if it is always subject to manipulation, why invest in it in the first place?
Well, the manipulators can only go so long. It is alleged that in my youth, I constructed several short squeezes. Those are short-term phenomenon. I'm not somebody who believes that there's been a 30 or 40-year thoroughgoing conspiracy to depress the price of silver. You didn't have to do it because most of the time the price of silver was going down. Why would you strive mightily to do something that was going to happen via gravity? But I know that all markets in the near term are manipulated. The LIBOR market has been manipulated. The U.S. Treasury market has been manipulated. Those are much larger markets than the silver market. And in a market where the futures volume is so large relative to the amount available for good delivery, near-term market manipulation, albeit expensive, is really ludicrously easy. If you were going to do it on the short side, you construct a short ladder in the futures market, 3 months, 6 months, 12 months, 18 months, something like that. You develop a good size short position for fun. We'll call it $1 billion. You borrow a bunch of physical silver and you sell that physical silver as aggressively as you can during the most illiquid part of the trading day, attempting, as an example, to drive down the silver price 3%, 4%, 5%, and have that precipitous decline in the physical market impact the quotes in the futures market. Cover your shorts on lock limit down days, pay back the silver that you owned, and walk away with a profit. I remember in the decade of the 70s where there was allegations that exactly that same type of manipulation happened on the long side. Manipulators generally do what's easiest. If there's a negative bias, they try to manipulate on the downside. If there's a positive bias, they try to manipulate on the upside. But the idea that silver markets aren't in the near term manipulated is extremely naive. The reason why one would invest in silver is because you don't care much about the noise, the trading noise in the near term. If you believe, as an example, like Rick Rule, that the nominal price of gold has a threefold upside, what happens next Friday is of very little consequence to your belief. To me, the intraday, frankly, the inter-month price moves are irrelevant. I'm thinking in 4-year terms, 5-year times, and I'm thinking in terms of quantum moves. Mm-hmm. The difference for me between $40 and $42 is absolutely inconsequential. It just absolutely doesn't matter. And I would argue that most speculators who think that they can outguess the bullion banks or the big financial syndicates, short syndicates, are delusional.
So then give us your long-term silver outlook, the price that you're focused on and not those smaller moves.
In my experience, Michelle, at some point in time in a precious metals bull market, when the generalist comes into the market, I think we're just seeing that now, silver begins to outpace gold. Please don't ask me why, because I don't know. I just know that. Perhaps it's the lower unit price. But in the 3 precious metals bull markets that I've lived through, at some point in time, silver decouples from gold. Perhaps we've seen that in the last 4 weeks. And when that happens, for a time at least, the silver price seems to move twice as fast as the gold price. I need to say that that's not how I invest or speculate anymore. I own physical precious metals to maintain my purchasing power rather than to speculate or to make money. But there's a whole different class of investors than I who could be expected to be attracted to the volatility and favor silver over gold. And if past is prologue, one would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line to speculate that the silver price could go up 600%.
When we talk about the silver market being distorted by paper silver, what we're really talking about is a modern alchemy, a financial trick that turns thin air into a market that looks liquid but isn't backed by anywhere near the amount of physical metal it pretends to represent. And when you start pulling back the curtain, you realize that what's being traded in New York, London, and Zurich every day has almost nothing to do with real silver. The kind you can hold in your hand, melt down, or store in a vault. Let's unpack that because it's one of the most misunderstood dynamics in the entire commodities world. In a typical day on the COMEX, the main U.S. futures exchange, the notional volume of silver contracts traded can exceed 200 times the amount of silver physically available for good delivery. I'm not saying 200% more, I'm saying 200 times more. That means for every single ounce of silver that could theoretically be delivered, there are 200 ounces worth of promises changing hands on paper. Now think about what that means. Imagine a bank with 200 customers who all think they have a claim to the same 1-ounce coin. They all have their account statements, they all believe they own silver, and they all trust the system, until the day more than one or two of them actually tries to withdraw their coin. That's when you find out the vault's empty, the doors are locked, and the manager's gone golfing. That's the paper silver market. Now, most of those futures contracts never settle in metal. They're rolled over, cash settled, or arbitraged away long before the delivery date. And that works, as long as no one asks for delivery. But in moments of stress, when investors suddenly do want their metal, the system creaks. And if that imbalance ever grows too large, if enough people stand for delivery, then you have the setup for what the silver community has been talking about for years, a genuine short squeeze that could rewrite the price structure overnight. But, and this is critical, if that day ever came, don't expect the exchange to let it play out naturally. These institutions are not designed to serve you. They're designed to protect themselves. If too many people demand delivery, the COMEX isn't going to shrug and say, well, good luck, let's see what happens. No, they'll halt trading, declare force majeure, and cash settle the contracts at an arbitrary price that keeps the members solvent. You'll get a check instead of silver, and the price they choose won't reflect reality. It'll reflect survival. The exchange exists to protect the exchange members, not you. Now you might ask, Rick, why does this happen in the first place? Why so much leverage? The answer is the same as it is for everything else in modern finance: greed and convenience. Paper silver makes it easy for speculators, hedge funds, and banks to trade silver without dealing with the inconvenience of storage, shipping, or insurance. It's cheap, it's fast, and it's incredibly profitable, until it isn't. Let me give you a sense of scale. There are roughly 1 billion ounces of silver mined globally every year. Meanwhile, in a single week, COMEX can see trading volume representing tens of billions of ounces. Think about that. The entire planet's annual production traded dozens of times over in a matter of days, without a single truck leaving a refinery. It's the ultimate paper Ponzi, a system of derivative claims so big it dwarfs the underlying reality. And it works until it doesn't. You see, the same thing that makes these markets so efficient is also what makes them so fragile. The leverage cuts both ways. As long as everyone rolls their contracts and no one demands physical delivery, the illusion holds. But when cracks appear, say a supply chain disruption, a logistics squeeze, or an arbitrage opportunity between London and New York, the stress can blow the system wide open. We saw that not long ago. A 4% discrepancy opened up between the London and Chicago quotes. That's what traders call a location premium. It was so lucrative that it made more sense for futures holders in the US to actually take delivery ship their silver to London and capture the spread rather than roll their contracts. That's how stressed the market became.
When we say that the silver market is distorted by paper silver, what does that mean? Break that down to us. How big is that distortion?
Let's not worry for a second about the exchange-traded derivatives, the ETFs, the Sprott physical products, because I think those are accounted for in the silver market. The claims that have always bothered me are the claims in the futures market. It is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. Now, virtually all of those claims, until very recently, cash settled, which is to say they weren't held for maturity. They were rolled over, whatever happened. Very recently, because of location disparities, which is to say the London market not having enough gold, there was a location premium for gold in London. And what that meant was futures holders in the US would actually take delivery of the physical silver and ship it to London to take advantage of as much as a 4% disparity in the London quote and the Chicago quote that was contemporaneous, a 1 day 4% premium. When that happened, the gold lease rates in the United States skyrocketed because rather than leasing gold, it was easy to make 2 or 3 or 4% simply shipping that gold to London. What has always scared me was an imbalance between supply and demand, between the physical gold and that paper gold, if more people stood for delivery. Make no mistake, Michelle, if you have a real imbalance in the futures market, you are going to engineer the massive short squeeze that the silver people hope for. What the exchange will do is that they will halt silver trading. They will set an arbitrary price between buyers and sellers, and they will cash settle. That's what will happen. The exchanges run for the exchange members' benefit. That notwithstanding, that sort of market turmoil, what is likely to be the agreed upon cash settlement price, were that shortage to occur, I think would likely be dramatically higher in the circumstance that we see today than the price is today. And the dislocation in a market where 200 times the claims, where there are 200 times the claims relative to the amount available to settle on a daily basis, is a market that's really, really, really ripe for disruption.
When you say 200 times, you're saying is that like a 200 to 1 ratio?
Yes. Now, that doesn't happen every day, but there are days when, if you look at the physical silver available in North American futures markets, on the COMEX as an example, good delivery silver in system available for the settlement of the claims, it is not unheard of to have 200 times that amount of silver traded in contracts on a daily basis. Now, the huge majority of those things cash settle. They aren't presented for delivery.
Let's be clear. What we're describing here isn't some tinfoil hat conspiracy. It's a structural flaw built into the way modern commodity markets function. The silver market isn't rigged in the sense of a few guys sitting in a dark room twisting their mustaches. It's distorted because the incentives of the system reward leverage, not ownership. Think about the players involved. The bullion banks, JP Morgan, HSBC, Scotia, when they were still active, make their money by facilitating trades, not by holding metal. The exchanges make money on volume, not integrity. The regulators, frankly, are asleep at the wheel or captured by the very institutions they're supposed to oversee. And so the game continues day after day with more paper stacked on top of less metal. It's like a global pyramid scheme that everyone's pretending isn't one. Because as long as nobody yells fire, the party goes on. Now, occasionally we get reminders of how fragile this all is. Think back to the silver squeeze of early 2021, when retail investors briefly tried to stand for physical delivery through SLV and other ETFs. What happened? Within days, the custodian of SLV, JP Morgan, issued an emergency statement saying essentially, We might not be able to source enough silver if inflows continue at this pace. That was the first time the system publicly admitted its limits. And what did they do next? They changed the prospectus language to make sure they'd never have to admit it again. That's how fragile this system really is. And yet, it persists because it's convenient. It allows governments and central banks to keep precious metals prices subdued while they inflate their currencies into oblivion. It allows hedge funds to speculate without ever touching the underlying asset. And it gives the public a false sense of stability. Because as long as gold and silver aren't skyrocketing, people assume everything's fine. But here's the thing, it's not fine. The same dynamic we're describing in silver exists, to a lesser extent, in gold, and even in other commodities. The difference is that silver is smaller, thinner, and easier to manipulate. That's why it's the canary in the monetary coal mine. Now there's another layer to this distortion, one that most people never see. The global location arbitrage I mentioned earlier, between London and New York, isn't just a trading glitch. It's a symptom of a much deeper problem, the fragmentation of trust in the financial system itself. When traders can make 4% in a single day just by moving metal between vaults, that's not a market functioning properly. That's a market gasping for air. And every time that happens, you see ripple effects elsewhere. Lease rates spike, vault inventories fall, premiums rise, and everyone scrambles for cover. The same thing's happening right now in smaller retail denominations. The 1-ounce coins and 10-ounce bars, the bread and butter of the investor class, are increasingly scarce. Dealers can't hedge efficiently because the paper markets they use for protection are so distorted that the cost of hedging often exceeds the margin on the product itself. That's why premiums explode during volatility. It's not greed, it's broken mechanics. Meanwhile, institutions like Sprott, which deal directly in wholesale quantities, can still get metal, for now. But even they're seeing signs of stress. There's no shortage of good delivery bars today, but the pipeline is thin, the logistics are tight, and the lead times are stretching. And when the next crisis hits, when another arbitrage window opens, that supply will dry up faster than most people think. Here's the irony. The silver market isn't small because people don't care about silver. It's small because it's been intentionally engineered that way. The less attention it gets, the easier it is to control. The less investors understand it, the easier it is to manipulate sentiment. And that's why I keep saying, don't confuse the price with the value. The price you see on a screen is a reflection of paper trades, of leverage, speculation, and computer-driven noise. The value of silver is something else entirely. It's determined by the metal's irreplaceable role in modern technology, its 5,000-year history as money, and its growing scarcity in the ground. Silver isn't just another commodity. It's the connective tissue between the industrial and monetary worlds. It's in your phone, your car, your solar panels, your medical devices, and your coin collection. It's a bridge between energy, technology, and finance. And yet, we're treating it like a penny stock. That disconnect can't last forever. Eventually, either the paper system breaks or it gets forcibly rebalanced by reality. Either way, the result's the same. A massive repricing of physical silver relative to its paper counterpart. Now, when I say repricing, I don't mean a gradual drift higher over decades. I mean a sudden, violent realignment. The kind that makes headlines and changes balance sheets overnight. The kind that happens when leverage meets physics. Picture a dam holding back a reservoir. Every day the cracks widen, but the engineers keep patching them with tape. One day they can't patch fast enough, and the whole thing bursts. That's the silver market. And when it bursts, it won't just affect silver. It'll shake the entire financial structure, because silver is intertwined with credit markets, industrial supply chains, and investor psychology. The people who think of it as a niche asset will be the most surprised. So what can an investor do? First, understand the distinction between paper exposure and physical ownership. If your silver sits in an ETF, you own a share in a trust that may or may not hold metal. You don't have claim to specific bars. You can't take delivery. You can't verify inventory. You have counterparty risk, custodian risk, and regulatory risk. Physical silver, by contrast, is simple. You own it. It doesn't need permission to exist. It doesn't default. It doesn't roll over. It just sits there, inert, incorruptible, and immune to monetary policy. Second, recognize that price suppression creates opportunity. Every artificial dip is a subsidy for those willing to take the other side. Every engineered sell-off is an invitation for disciplined buyers to accumulate real metal at a discount. And finally, keep perspective. Markets like this don't break slowly. They break all at once. It's tempting to look at today's manipulated price action and feel discouraged, to think the system will always win. But history says otherwise. Every fiat system eventually meets its limit. Every paper promise eventually collides with the reality of finite resources. When that collision happens, the people who hold the paper will get cash settlements. The people who hold the metal will get wealth.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.